Welcome back to another episode of Playbook of the Wealthy. My name is Dave Grant. My co-host is Heather Townsend. Today we're talking about the investment accounts that you need to be using and in the correct order that we use personally and for our clients. If you've been here before, you obviously know the format of our podcast. We dive deep into content, we answer questions, and then we share personal, professional stuff about ourselves, however we want to share. So sit back, relax. We are going into our first segment. It is called Let's Dive In. All right, Heather. As always, set us up.
What are the 4 accounts? Dun, dun, dun. All right, I'm going to try to do this Eli 5.
Some people don't know what Eli 5 is yet.
You had to tell me what Eli 5 is. I didn't know what it was.
Explain like I'm 5. So you're talking to a preschooler.
Yes, that is what Eli 5 is.
Yeah, but some people don't know the acronym.
I get it. It basically is explained to a 5-year-old.
Yeah.
I don't know how... If I had to explain this to a 5-year-old, I'm going to try right now. Do you know how? My daughter, I have almost a 5-year-old. My daughter would not understand any of this.
Yeah, you have money. You save it. That's the extent they would understand.
And then the government takes some of it. So
what's the government, Mommy?
So then we take the percentage. Yeah, okay. So there are 4 accounts. Number 1, you have a pre-tax retirement account. Normally that's a 401k or a traditional IRA or a SEP IRA or solo 401k or simple IRA.
Don't forget these teachers, 403Bs, 457s.
Yes, there's a lot of them. Okay. Point being is you get a tax deduction when the money goes in. But come on, the government's going to come for its money at some point. So when you go pull it out in retirement, it's going to get taxed. Okay, that's number 1. Number 2 is Roth. Many people know about this. That can also be within a 401k, a solo 401k. I think they added it in a SEP IRA. I don't know. I have to go back and look, but
And an IRA.
And a Roth IRA. Okay. This is when no tax deduction up front, but when you pull it out in retirement, all that growth, all that money you contributed, no taxes. Nice. Okay. Number 3, a regular investment account. A lot of people call these different names, so it's very confusing. Brokerage, taxable brokerage, what other names?
Non-retirement.
Non-retirement. We're just going to call this your regular investment account. You think that's good? We're just going to call it the regular investment account. It's non-retirement. It's just an investment account. So that means you can pull it out at any time. No penalties. All you're doing is paying capital gains tax on the growth. So you bought something for $100. You sell it. It's now $130. You're just paying capital gains on that $30 growth. Okay. Then my favorite, the HSA, the health savings account. Those are really the 4 investment accounts. Why it's my favorite? Tax deduction going in grows all tax-free, like all the other retirement accounts. And then when you pull it out, no taxes. Note that's different than a Roth, because Roth, you had to put in after-tax money. This is pre-tax. Ding, ding, ding. I'm going to convince you, Dave. I'm going to convince you.
So weird.
I am. I love money. I do, clearly, with what I do. So those are the 4 accounts. Again, pre-tax retirement, Roth, regular investment account, and HSA. I don't know what Dave's answer is, so I should tell our listeners, we put in the Google Doc what our order is. And I actually don't know what you're going to say. I don't know if you read mine.
I did.
I'm going to take a bet that HSA is higher on mine than it is on yours.
100%. You love this thing like it's your 4th child, your business being your 3rd. We did a whole episode on this because you loved it and you wouldn't stop badgering me to make an episode on HSAs. You love them.
I do. Let me ask you this, though, and this might be why. Do you have any retirees with HSAs?
That have them, that have funded them during work and now have them?
Yes. Oh, and they're not using them?
Not right now.
Why not right now?
Because they don't have the health expenses.
Are they 65 and older?
No.
They don't have health expenses?
Not yet.
That's amazing. Okay, my clients must be different. All right.
The Midwest air.
Yeah, maybe. All right. So, number 1, I go 401k first, the pre-tax. Most of the time. And especially if there is an employer match, you are not leaving that free money on the table. That's just stupid. I don't like to use that word stupid, but that is leaving money on the table. Let's just not do that. So 401k first, Then I go HSA. You're not shocked by that. Then I go Roth, backdoor or regular. And then I go regular investment account, brokerage. Now, I'm going to asterisk this, that if there's someone like Dave, where your wife is getting a pension that's going to be, I'm guessing that's ordinary income, and I might change this, right? Yeah. There are things that might derail my order, but in general, that is my order that I go in of priority.
Okay. The part that's always on my mind is, well, what if someone doesn't have an HSA available to them? What if that's not the best healthcare plan?
Well, then I don't do it.
Does that kill you a little bit inside? I mean, they can't use the HSA. It's not the best solution for them. And then you're just like, well, just change your healthcare plan. Get the HSA.
I mean, I will say, I'm going to be open because there's growth. People have to grow. The baby, even 5 years ago, Heather, she was pretty rigid. Like, I don't know if you've seen my self-growth, especially after having kids.
Okay.
It would have killed me more 5 years ago. Now I'm like, okay. Like, it's what's best for the client.
Yeah.
But there was an old version of me that really would have died inside.
HSA does not rank that highly on my list.
Not surprised.
Because, I mean, I have some clients that have a wonderful PPO plan, but there's no HSA available. Or it's going to be that they have the HSA and the high deductible healthcare plan, but that just doesn't fit. And so I'm like, yeah, use an HSA. Cool.
Do their employers contribute to the HSA?
Some do.
Wow. Okay. I mean, we are just, this is one of these, like the paying down the house. We now have two. I'm not excited about paying down houses most of the time. You are. And I am really excited about HSAs, and you are not.
I can see you squirming in your seat. It's quite uncomfortable for you, isn't it?
No.
Come on.
I'm getting better with it.
All right. So I'm going to give you my order then.
Okay, let's go.
Can I kill you a little bit more inside? Can I tell you where this comes from?
Oh my God, you're going to go... Is your number one different than mine? Give me a...
No, this is coming from the days before I was a financial advisor listening to Dave Ramsey.
Oh, dear. Okay, I'm buckling up. Hold on. Whew,
You
okay.
like me as Dave. You're not too fond of the other Dave.
I am, for the record, for debt pay down, but those are not our clients. So, okay.
So my order is 401k up to the match, and then you stop. Assuming your income allows you, then you go and fully fund a Roth IRA.
Yeah, we are different.
Then you go back to your 401k and you fully fund it up to 15% of your income, assuming you can hit that with various limits. I know that that's going to be slightly different if people's incomes are higher or lower. Then you would go to an HSA. I can see your face right now. Because an HSA has different priorities.
You put it as number 3.
Yes. Let me keep going.
It's not last.
Let me keep going.
Wait, it's everyone. Did everyone listen? It's not last.
Matt, you cut her. Please. She interrupts me all the time.
Wait, no, I think this is good. I cannot believe that it is not last. All right, keep going. Matt, don't cut that. I am shocked.
So HSA, if it's available and if it is appropriate.
Okay, deal. Yes.
Then I'm going after tax in the 401k.
That wasn't an option of the counts. It's
still a 401k.
Fine, I'll let you this one slide.
So,
he broke the rules.
That's why they're there. So after tax of the 401k, so you can then do a Mega Backdoor Roth.
Yes, but that's part of the Roth category.
Sure. And then it's taxable until the end of time.
Yes,
you run out of money.
Agree.
People then throw in conversations of, okay, well, can I throw in too much money to my taxable account? Should I then diversify into like rental real estate or to like specific investments?
If you want it.
I say no. If you want to be a landlord and you're specialized in real estate, then yes. If you're doing it because you want to be diversified, go and buy a real estate investment fund.
True. Yes.
You're not built to be a landlord just because you think you have too much money. No. People are landlords.
And it's not liquid. You know what's interesting? Is it's personal financial planning, right? And maybe that's why this order was hard. I would say Mega Backdoor Roth is actually probably my last, though, interestingly enough.
Okay.
Because I really don't want a client to retire to with all pre-tax, all Roth, and even maybe some HSA, but no brokerage.
I think it depends on your income.
Okay.
Like if I'm having people that are fully funding their 401k, let's say we're talking about pharma clients, pharmaceutical execs, high income, typically have very generous benefits. by the time they get to funding the after-tax portion of their 401k, they don't have much room left because they've done pre-tax. Their match is sometimes almost as much as their pre-tax contribution. Like it's hefty.
Whoa, that's so nice. So it's high income. Yes.
So if we're hitting, 70,000 or 80,000, they might have 20,000 left to do after tax for a Mega Backdoor Roth.
Yes.
That's very different for other people. Like they could be funding $24,000 and only get a certain, $2,000 to $4,000 match.
Yes.
If it's really small, then they've got a huge amount of room
120.
that I might not max out at that point.
You would put Mega Backdoor Roth if they have no investment account. They have no brokerage account.
Again, that wasn't the requirement of this.
Okay, you're just in order. So we can do Okay. All right.
I'll say again, it is highly dependent on income. If I know that they are going to completely max out that 401k up to the IRS limit and they're going to have some left over, then I'm going to do that because they're then still going to have some diversification amongst their accounts. And we're not just leaving the taxable alone and it just being unfunded.
You know what's interesting? I think also why I put 401k and HSA first. This is especially for even my business owner clients and high income earners. People hate taxes, right? Mm-hmm. So there's this open manipulation where I'm like, it's a tax deduction. It's a tax deduction. They do the thing, right? So then that's like already I get some automatic savings out of the way. Mm-hmm. The Roth and the taxable, like the regular investment account, there's no tax deduction. So that might take a little more, okay, now we're going to do this, but they're not as excited. They love saving taxes. So it's like, boom, boom, they do them right away.
I think I've probably changed my tune of this order. It's probably changed recently because I have been working with 401k plans that are very restrictive on Mega Backdoor Roths. Or it's just a pain in the butt that I'm having a client do another thing that is not part of their job, which is also highly stressful and takes them in worldwide travel that they don't have the time. And so is it worth it for me to give them another to-do list where I could just say, just give me all your excess cash flow after your 401k and we'll invest it somewhere else. So there's also that PITA factor, pain in the rear end factor. I'm not using the A word because we're a PG-friendly podcast. I don't want to make things difficult for people.
Well, simple. People don't like complex. Mm-hmm. So, Dave, really quick, because we keep throwing this out, do we want to discuss what a Mega Backdoor Roth is? Because I think there's the Backdoor Roth, there's the Mega Backdoor Roth. Like these terms are thrown out all the time, and they're confusing, and they're different too.
Yes, I specifically between the Mega and the normal. So yeah.
The normal I can explain all day. It's you're over the income threshold that you can't directly contribute to a Roth IRA. So you're not allowed. But there's a backdoor, loophole, whatever word, but they call it the backdoor. So you do a non-deductible contribution to a traditional IRA. So you're not taking the tax deduction on it and you're converting it to Roth. There's a lot that comes with that. Please make sure you have a good CPA. I see this messed up all the time. I've said this multiple times where if a CPA doesn't know what this is, they make it taxable on your tax return. And most people can't read tax returns, so they have no idea that they're paying tax on that money. Mm-hmm. Please have an advisor or a CPA that knows what it is. Do it.
So Mega Backdoor...
The
Mega Backdoor Roth contribution, or it's essentially a conversion.
Yes.
You're doing this to your 401k. So you're contributing after-tax money into your 401k.
So no tax deduction on the contribution.
Right. So it's like that when you did it to the traditional IRA for the normal, but you're actually doing this to your 401k, which means there's no limit. You're going up to the IRS limit. So this could be $10,000. This could be $40,000. You're just putting as much as you can in, not taking a tax deduction. And then depending on how the plan is written, you can either take it out immediately and convert it over to a Roth IRA, or you may have to wait. Sometimes plans stipulate how many withdrawals you can do for a conversion, and they may say it's once a year or it's once a quarter. It can be whatever you want it to be with the plan, but you have to follow those rules.
One client of mine, I was surprised because it wasn't a really tech-savvy company. Mm-hmm. And I said, hey, I saw they had after tax. So I'm like, wait, let's see if we can do because you can see the option in the clients. And I'm like, hey, call in and ask them if they can convert this to Roth. So she actually called. I was really impressed. And they said, per paycheck. And I was like, yes, select, make sure that happens.
Do they do it automatically?
Yeah, it goes in after tax and then they immediately convert it to Roth. I've seen a few tech companies do that. This one wasn't a tech company, which is why I was so surprised. So savvy 401k administrators, whatever the term is that you want to use, they are crafting some plans to make it more where it's not just once a year.
I would say the big reason why I'm pushing this to more people than others is rapid income changes. So I've had one family, they're very blessed financially. Their income has gone up $500,000 since last year.
Oh yeah, take advantage.
So now we're like, okay, we need to max out everything as much as we can.
I love that problem.
So now I'm figuring out, okay, so this might be a pain for you, but in the long term, this is really going to work out. We're running out of room to put money in different places. So we need to do everything we can in every situation.
It's beautiful. I love the Mega Backdoor Roth. That's when to put it simply, that's when we have income coming out of our ears problem.
It is. That's really where it's really useful.
Yes. Why are we going in this order? The one thing I want to say to people is you can't just have one account when you retire. That is actually probably any financial advisor's nightmare. That's my nightmare. I do not want you to show up and you have all pre-tax money. There's not as much as I can do. The clients that have a great retirement probability of success and a high withdrawal rate out of their portfolio have at least 3 of these 4 accounts. 4 is my ideal. 3 is Dave's ideal.
If you have an HSA, I don't care.
I don't care as much.
I would agree. I'm still pushing retirees. Like if you are still imbalanced, if you still have a lot of pre-tax, which is going to be the majority of the US public, because that's how we're pushed and driven just based on media and lifestyle. But it's going to be, if you're still imbalanced in retirement, I am pushing Roth conversions hard because you've still got 20, 30 years of retirement left.
Yeah.
And you're going to need some tax-free money at some point. Let's do it while we're in a lower tax bracket while we can, because you'll use it eventually.
Yes. And why Dave and I say that, if you've heard us before, we pick what tax bracket our clients are in financial freedom. And the way we're able to do that is based on these counts because they're all taxed differently. So then we pick where are we pulling from these accounts in financial freedom to get to that beautiful tax bracket we want to hit. And more importantly, if someone wants to know, I'd love to share on the podcast, but I don't know where tax rates are going to be in 10 years or 20 years or what Congress is going to decide. I don't care what party you are. Like, it flip-flops, I feel like, every administration, right? Like, so this way, depending on whatever the tax laws change to, we can change our plan. Yep. You got to be diversified even in your tax bracket, like tax wise, which is so, I don't think a lot of people talk about that.
True. I'm going to throw a wrinkle in this. And it's going to be for the people that are very close to their family. What I found is that let's just pick on generations. Let's pick on boomers who will, if they're the older end, they're going to pass away in maybe 15 years. If they're going to leave a large inheritance to their children, and I work with the children, and it's going to be a huge IRA that's coming down, and it's pre-tax, I will likely tell the children, I don't want you to do any pre-tax savings. And it's not from the fact that I don't want them to save on taxes. I don't want them to have a lopsided portfolio when they hit retirement because of that inheritance. So it looks like on the face of it, I'm doing wrong planning, and it doesn't work from a tax perspective. But when you kind of stretch out and say, well, what does this look like from a life perspective? If you're going to get that big inheritance, that is going to skew your portfolio immediately from a tax perspective. If you've got things that balance that out that you've done over your lifetime, you're going to be in a much better position when you get there.
I actually have a client in this situation, and I feel so bad for her because she could potentially inherit millions and millions of dollars to the point where we actually shouldn't even be saving that much right now. If that's the case.
Yeah.
But her parents are so close-lipped about their wealth and sharing with her that we have to save because I can't count on it.
Yeah.
And I mean, we openly have this discussion. It's not like I'm just deciding. I mean, we're a partnership. That's where I think good financial planning is. But, I tell her, like, the trade-off is if you inherit all of this money, what we're doing today, we shouldn't have done. And there's an opportunity cost for you right now. You're not taking that other extra trip you want to do or something like that, or the bigger house you want or whatever. And again, this is where like die with zero, I think, is just one of my clients on the other side. Her parents gift her money every year, and it's so beautiful. And they're gonna, probably redo their kitchen or whatever. And because they don't want to die with all that money.
Yeah.
And, I guess that's the beauty of being in this seat and seeing the client's pain that they go through and when it's done well. And I'm like, not doing that to my kids, right? Like, no, I'm going to share. Mm-hmm. We're having a family mission statement, for gosh sakes, about where our money goes as a family.
The 5-year-old's going to have some input?
Not yet. I think they're too young, but I think at 10, I'm going to start like real serious, like money talks with my kids. Mm-hmm. Maybe 12. I don't know yet. I have to do some more research. But point being is I think that this is a great example of, knowing you really got to look at a whole. And I think inheritance has to be taken into this consideration. And going back to one story I said, one of my clients is going to inherit huge pre-tax IRAs. We know at some point.
Yeah.
So we are doing Roth conversions now. Mm-hmm. Yes.
Talking about kids, regardless of their age, I have older kids than you. Some are very receptive to this conversation. Others don't care.
No, yeah.
Which then travels into adulthood as well.
That is that's probably my biggest fear.
Yeah.
Is like having a kid that doesn't care about, I won't know what to do with that.
Is it going to be an alien to you?
Yes, I live and breathe money like all day long. What?
All right, before we move on to the next part of our podcast, if this is not your first time here, if you're coming back, I need something from you. I need a like, a comment, a follow, subscribe, send it to your mom, put it in the boys and girls chat. I don't know, anything you can do to kind of spread this out there. It doesn't have to be a lot, just a like. That's all. No one knows what the likes are. No one can track you. It's okay. But we appreciate it a lot. And it helps us share our platform. It helps us grow bigger so that we can share it to more people. If this is your first time, don't do anything. Just enjoy the content. Figure out if you want to come back and listen to more. We're going into the next section of our podcast. It is the question section, and it's called What Would You Do? Alrighty, question number 1. I'm 45. I've been advised to contribute to my 401k for the tax deduction, and I've been doing that for 20 years.
Oh.
Now my portfolio appears unbalanced. Should I alter my strategy as I move into the second half of my career? Heather.
I'd say 120% yes. 45, I'm assuming they've gotten close to maxing out that 401k. That thing has to be 7 figures by now, if they did it right. 20 years with matches, I'm going to guess that's 7 figures. 7 figures of just pre-tax money. Yeah, you have to change your strategy. Yes. If you have high income, I'm glad you listened to this episode because you're going to start going through our order. Depending on what you like better, HSA or Roth is number 2, depending on who you want to listen to. And then add in some brokerage for sure, taxable investment account. But you need all 4. You need to split that around. And hopefully if you have extra income and you're in a high income tax bracket, you just max out that 401k, you do the backdoor Roth, you do an HSA, and you put like 40 to 50 grand in taxable brokerage account every year. I'd be over the moon.
The part that's interesting is when there's not much else cash flow wise, and someone says, I've done this, should I be changing things?
That's so hard.
Because my answer is still going to be yes. But it's going to be yes, but. Mm-hmm. It's going to be yes, you've maxed out the 401k, and it's still going to grow. It's still going to get bigger and bigger, but you need to change the strategy. You're going to be paying more in taxes as a result, whether you do Roth or if you do a taxable account.
You know what would be hard on me in that situation is, you'd have to really map this out. I'm just thinking out loud, but it's like, do you do the Roth through Roth conversions later? So you start building up cash, be like, that's going to be the plan 5 years before retirement. Then we're going to do Roth conversions, when you retire and you're going to live off that cash. And that's how we're going to get some Roth in your portfolio. So we just do taxable, the regular investment account now.
Yeah.
That would be a really fun scenario, but hard too.
Yeah.
I like when there's more money. I like when I have all. I like it all. I don't like an or. I'd just probably be like, we got to get you a raise.
Yeah. This is not as simple as a question as it appears.
No.
There's a lot going into that.
Yeah. I am currently in the 24% tax bracket. Should I consider Roth conversions now or wait until retirement when I might be in a lower tax bracket?
If you were in any other tax bracket, this question would be easy. Reason being is when you look at tax brackets, the 24% is one of the biggest tax brackets, but it also jumps up to higher tax brackets, which are very narrow. So if you start adding income when you're in the 24% tax bracket, you're getting taxed aggressively after that. So I'm going to kind of caveat and say, well, where are you in the 24% bracket?
Are you high or low is what you're saying in that band? Like, are you more leaning to the low band? Or are you inching up to the 32? Like you're about to, okay.
And in saying that, I typically like to take people to the top of the 24% tax bracket as a maximum when I'm considering income and Roth conversions. So should you consider them now? If you're in the lower end of the 24% bracket, potentially. It depends what else is going on.
But they also said lower tax bracket in retirement.
When I might be.
Okay.
There's so many caveats there, though. That's the thing. Like, you could be in a lower tax bracket, or the tax brackets could change.
Is this why we're on 54 episode of Talking About Money? Like, the amount of stuff that we can do in a day and consider is wild.
Yeah. And what's the lower tax bracket here? Are you going from 24 to 22, or are you going from 24 to 0?
Yeah, that's
a big
material.
difference. So it's, again, there's a lot to look at. There's a lot to understand. What's my opportunity cost? Do I do it now and pay this amount of tax that I know? Do I wait and roll the dice on what tax brackets might be, what my accounts might grow to? Again, if you've got an explosive amount of growth in the stock market, you're converting a huge account. If it's static or it goes down, that may be advantageous because you're able to convert a smaller amount in potentially a smaller tax bracket, which is a huge boom if you then go in a growth mode.
You know what I would do? Like, not even convert, just have them put a portion of their 401k percent in Roth, or do a backdoor Roth. We could also uncomplicate this too, right? We could just build it.
But that's the reason we have jobs, because we make things so complicated.
I know. I'm like, couldn't we just, there's also another workaround on this.
Yeah. So the answer to that question is, it depends.
The other thing I want to add in that I think people forget about is tax rates aren't guaranteed. You might be in a lower tax bracket what you think now, but I don't know where tax brackets are going to be in 10 years. They could be higher. They could be lower. How do you know what tax brackets are going to be in your retirement?
Yeah.
You don't. Okay. I have after-tax money in my 401k. Is there an optimal time to perform a backdoor Roth conversion, or does it matter? I think they mean Mega Backdoor Roth conversion.
Yeah. There is an optimal time, as quickly as you can, because if you do the Roth, if you contribute to the after-tax portion of the 401k,
and you let it
if you leave it alone, the money that it grows to, the growth of that is all pre-tax money. The contribution is still after tax, and that amount can be rolled out. Well, why would you want that money to grow and be pre-tax on the growth, or you could move out immediately and have it all be tax-free? But you're restricted to what the plan will allow you to do.
Yes.
So whether you can do it immediately, do it immediately. If you have to wait and it's one time a year, you're stuck.
And Dave's using the term roll out. I also want to say roll out means it can stay within your 401k. You don't have to roll it out to like an outside brokerage Roth IRA. It can stay within the 401k Roth too.
I've never done that.
Really?
Yeah, it's always gone outside the plan.
Oh, mine stays in the plan. Oh, another interesting differentiator.
Yeah.
Yeah. I think it depends. I think if you have a 401k though, if I had a client plan with those heinous fees, like, I don't know, there's insurance company in the name, I'm going to roll those suckers out of the plan. But if it's a good 401k plan, I just keep them there for ease.
Sure.
Yeah.
All right, we're going into highlights. This is the section where we tell you personal, professional things about our life that you may or may not care about, but we do. So buckle up.
Oh, mine's funny.
You can tell your story at the end. All right, I'm going to go first. I'm in a phase of life where I have a 15-year-old athlete boy and a 13-year-old boy who can't sit still, so does sports all the time. I have to feed these athletes.
That's what I was thinking. I was like, do you go to Costco?
Yes.
Yes.
The amount of protein we go through for the football player, swimmer, tennis player is a lot.
Yes.
The amount of fees we pay in sports, which is what they love to do, so I'm fine paying it. But in the back of my mind, I'm like, when these kids are gone, how much of that protein powder and sports fees am I going to get back in my pocket?
Well,
That's
no.
going to be amazing.
Who knows what's going to happen then? But the funny thing is, oh my gosh, my friend, did I tell you the story that we went shopping when I went to visit her? Mind you, she doesn't have kids yet. And she's like, Heather, you're not going to buy the watch you want?
Mm-hmm.
And I was like, no. And she's like, well, Heather, the old Heather would. And I'm like, yeah, no. She was like really thinking about buying this really expensive bracelet.
Okay.
And then we got back and I was like, wow, we've really flip-flopped. And like, who was the bad one? Mm-hmm. And she goes, but wait a minute. You have kids. How much is your childcare?
Exactly.
How much is your... And I'm like, oh, 1 month of that is that very expensive watch I wanted, right? Like it completely, there's my like discretionary. I mean, I wouldn't want it to go anywhere else for the record, but kids are fluffing expensive.
They are.
Yes.
So in the back of my mind, I was like, when does this get cheaper? Because it didn't get cheaper after daycare. That amount of money just changed into different places.
That's what I'm planning for. I'm like, I have girls. Like you have boys with sports. I might have girls with sports. And they're going to care about what they wear, most likely. And hair.
Do you have any friends who have girls as dancers?
Yeah, I have clients. I know. Let's just not go there right now. Okay.
My kids play sports in our town. Those girls dance across the country.
Mm-hmm. Oh, I have some clients that do the travel sports. That's thousands and thousands and thousands of dollars. That is insane.
Yeah, we do lower tier travel sports. We rarely go out of state.
So it's driving.
Oh, yeah. We spend a lot of time in the car.
Yeah, that's not as bad.
Highlight for you.
So I had an early flight to catch yesterday morning. We have this new shower from the remodel, and it has this like new slim grate drain that is built into the floor. And our shower door is glass, like the whole thing. It goes basically from like ceiling to floor is glass.
You have no lip to the floor to the door.
No.
Okay.
Okay. I mean, it's very modern looking. Mm-hmm. It's never been a problem before. But I noticed that the water was kind of getting a little high in the shower. But it was 5 o'clock in the morning, so I'm just going to still continue showering. I haven't had coffee yet. I'm like, oh, the glass will keep it in. So I walk out of the bathroom, and I'm like, oh, it didn't stay in the bathroom. It's on the floor. Okay, I'll just wipe it up. It's like regular, tile, pretty floor. So I walk into the master bedroom. I'm like, oh, fluff. Oh, fluff. Alex, B, that's what I call my husband, B. And he comes in and he gets to the water in the door. And it went all the way under a rug of our master, like our king bed, all the way to the other side to the curtains, my very expensive curtains in our master bedroom that are 2 layers of curtains. Mm-hmm. There was water I flooded the entire master bedroom. Brand new wood flooring. Alex had to pull up the king mattress, pull up the king bed to get to the rug so that we could dry our brand new wood floors. There was some curse words. And the funniest part is I couldn't really help because I had to catch a plane.
You get on the plane and then your girls are going to wake up. And, oh, geez.
I have a good husband.
Have you heard any update since?
He said it's okay, but the rug is drying outside. And he said, I like the bedroom without the rug. You interpret that in man code. What does that mean?
You're not going to mess up any more of this house. This rug's not coming back in.
I don't want to put the rug back under the bed, is what I heard.
Oh, good man code there.
Yeah.
Well, I hope you go home to a drier house.
Me too. Me too. Yes. And I owe my husband. I need to bake some cookies. He loves cookies.
Thank you for listening to this episode of Playbook of the Wealthy. If you want to listen more, you can find us wherever you find your podcasts. If you want to watch the video version of the show, we're on YouTube, Instagram, Spotify, and LinkedIn. If you want to email us your questions, you can. Go to our website. It is playbookotw.com. Our email is hello@playbookotw.com. Jordan's coming up. He's been waiting all episode for his spot, but we'll see you next time.
Email your questions. Toodles!
All opinions expressed by Dave Grant and Heather Townsend are solely their own opinions and do not reflect the views of their respective wealth management firms. This podcast is for informational purposes only and should not be relied upon for investment decisions. Nothing in this material constitutes a solicitation for the sale or purchase of any securities. Clients of Retirement Matters and Townsend Financial may maintain positions in the securities discussed in this podcast.